Hello and welcome to the first Indianomics edition of 2025, where we have done a special poll for you to map out how Indian macros may shape up. First up, the poll says the Indian rupee will slide to 86.25 by March 2025 and further to 87 by the year end. That's, of course, according to a poll of over a dozen economists and treasury heads. For the year end, the economists' forecasts are lie between 86.75 and 87.5. GDP growth is on an average seen at 6.4% for FY26, but the range is 6.3 to 6.5, while for FY26 next year, the growth is seen at 6.6%. The range again is 6.5 to 6.8. Finally, for inflation, the current year is seen averaging 4.8, which is basically the Reserve Bank's forecast. But for next year, the poll shows the CPI may average at 4.4. Well, that's the poll. For a more nuanced discussion on how the economy will pan out, what we may expect from the budget and monetary policies, I'm joined by B Prasanna, the head Global Markets Group at ICICI Bank, Kaushik, Cheif Economist at Deutsche Bank, and Upasna Bhardwaj, Chief Economist at Kotak Mahindra Bank. Gentlemen and Upasna, thank you very much indeed for joining me. Well, rupee is uppermost in the mind, Prasanna. So the first question is fired at you. You know, one thought when I did the poll at 86 quarter, and I did the poll late last year, around December 30th, it looked like 86 quarter by March end was okay. But the slide thereafter and the sharp rise in the dollar index to almost 108.3, do you think the weakness can be even more in the first half of the current year?
So, good morning, Latha, and good morning to my co-panelists and your viewers as well. So, I think slide is a very strong term, Latha. If you really look at the percentage depreciation of the rupee against the dollar, and especially when you compare it with various other currencies, it's much, much lesser than what some of the other currencies have experienced. So, while I do agree that the rates have depreciated a bit, you can call that the dollar index has actually appreciated substantially. It was just at 100.5 before the Trump trade started, sometime in September 30th or so. And after that, we have seen nearly 8.5% appreciation of the dollar, and hence depreciation of most of the other currencies. Rupee has performed relatively better than most of the other currencies. Having said that, what we do feel is that, unfortunately, we do feel that the dollar strength will possibly continue for at least a month more. And I think all of the fears of the Trump trade and the policies, whether it's on tariffs, corporate tax cuts, equity growth, inflation, as well as the fiscal deficit, all of that is getting factored in. Now it remains to be seen as how much of it is reality and how much of it is just fear. And accordingly, I think after the next 1 month plays out, the dollar will possibly either peak out and then react to the actual announcements by the president when he takes office.
Okay. No, I'm sorry if I gave you the impression that slide is a negative thing. On the contrary, I would think that we ought to be shoulder to shoulder with at least competing exporting countries, because already we, even before the Trump trade began, there were steel companies complaining to us that China is dumping, they are selling at below cost, with the renminbi depreciating already at 7.3. Okay, just tell me that. What are you all expecting in terms of renminbi depreciation? And therefore, should we be wanting and preparing for a cheaper rupee? Rupee has depreciated 3% in in 2024. Should it not be at least 3% in the current year as well?
Is that to me, Latha?
Yes, to you, Prasanna.
Yeah, I think our house view is for yuan to depreciate to something like 7.5, and depending upon what kind of tariffs come, we take it forward from there. And on the INR bit, I kind of also agree with the kind of poll results that you've got, which is that we are into a depreciating scenario. RBI will step in to kind of, measure the volatility a little bit. But I think the sense that dollar INR goes higher, the rupee depreciates is a given. So I would say that around 86 to 86.5 by this fiscal year end, and December end maybe close to 87, 87.5, I think is something that even I would subscribe to.
Okay. Well, let me get the growth dynamics in, and then coming back to you for interest rates and the bond index and the bond levels. Upasna, you have only a 6.1% for the current year, a little lower than the range of my expectations for FY25. Why are you factoring such a low number? Are you worried about domestic consumption faltering?
Latha, yes, I think we are looking at most of the indicators and they are suggesting that consumption is likely to remain extremely weak, and private sector capex too is not picking up at the pace at which we have been, anticipating. It's a rolling expectation that we've been holding on to for the private capex. So none of the two private sector categories primarily are expected to hold up. At the same time, if I look at the center plus state spending, that too is not picking, especially on the capex side. It's still not picking up pace, the pace at which we were expecting. The third quarter has passed by, and now we are left with the last quarter. What we need to keep in mind is the kind of excessive welfare schemes that the states have been announcing. And in order to meet their 3% overall targets, FRBM targets, they will have to compromise on spending somewhere else. And in that context, I think capex could still not be taking so much of a lead. So I guess somewhere all of this together, it's a more broad-based expectation apart from agriculture. We're looking at a reasonable slowdown across the board. At the same time, we need to keep in mind that last year, H2 was 8.2% average, and it is a very high base. So on that, we are looking at H2 of 6.2%. A little here and there, but broadly, yes, that is going to be there. Assuming that there are no changes to the number, of course, we might be seeing changes, but there, of course, I don't want to speculate there.
Yeah, fair point. Though, of course, the GVA number was lower, but yes, you have to contend with that 8.2% number. Let me come on that point to you, Kaushik. You are actually the optimist in our group. The poll we did, at 6.5, hardly any adherence to that number, except the Reserve Bank, which stands at 6.6. Where is that confidence stemming from? The auto sales numbers that we got for December were not very encouraging. GST at 7.3% higher seems to be indicating Q3 is not all that good. What's your sense?
Hi, Latha. First of all, Happy New Year, and
Thank you.
Happy New Year to your viewers as well. We knew that the second half of the fiscal year, there would be some pickup in growth. Also, we have built in the possibility that FY24 8.2% growth will probably be revised lower. So that will also give some, kind of support to the base. And all taken together, government spending, will increase more than the first half that we have seen. Already, we have seen some increase in momentum in October, December. Numbers could be, biased. The risk could be biased to the downside, but all taken together, I think we could come to 6.5% growth for FY25. But whether we are at 6.3, 6.5 for this year or next year, also we are at 6.5. The main point is we are going to be below the potential growth rate of the economy, which is at 7% or higher. And that's what we need to focus on. The numbers we can keep on quickly because it changes.
I agree. I completely take your point that, that is the larger question that both policymakers and citizens should be squabbling about. But I still want you to ask you whether there's a downward bias to your Q3 number. What is the Q3 GDP number? And having looked at what we've got, lead indicators, auto sales, GST numbers, etc., credit growth, are you likely to give a downward bias? What's the number? What's the bias?
So Q3, October, December, we have a forecast of 6.8% GDP growth. And I think RBI, if you've seen the latest monthly bulletin, they're also saying that currently the nowcasting is showing around 6.8% for October, December. Now, obviously, the quarter is not over yet. We'll get more data, and along with that, we'll make up our mind whether to reduce it. But as I told you, on February 28th, when we get the October-December GDP number, it'll come with a lot of revisions. So all these forecasts may not mean much. But I think we can go above 6.5% in October-December. Private consumption should pick up more, given what we have seen in October. The festival demand and government consumption on the margin would have picked up from the first half of the fiscal year. Kharif sowing has been good. So if you plug in all this together, and corporate earnings may not be as good as what we have seen in the past few quarters, but definitely better than July, September. That is the expectation. We should be above 6.5% growth in October, December. We have around 6.8. Whether it is downside bias, we have to decide by the end of the quarter when we get all the numbers.
No, I take your point that there's a lot of FMCG companies telling us that, rural recovery is good, and even tier 3, tier 4 cities are showing some spunk. But I don't know about the nowcast of the Reserve Bank. They said that even in, when they gave us the October bulletin. And 6.7 was their nowcast. We ended up with 5.4. So the nowcast perhaps does not have all the data. Anyway, let me do one rapid fire with all of you in terms of the February MPC action. Upasna, rate cut, February MPC?
Yes, but it's a close call. Yes.
Okay. Kaushik?
Yeah, we have a 25 basis points rate cut call.
Prasanna?
Yeah, it's a very close call, Latha, but I would go with a 25 basis point cut.
Okay, so 3-0 in terms of in favor of a cut. In any case, the MPC already was at 4.2 in terms of expecting the cut. But Prasanna, what will that do to bond yields? By the end of March 31, can bond yields, if repo is 6.25, do yields go down towards 6.5?
So I think, Latha, for bond markets, while we may all concur with a 25 basis point rate cut estimate right now, bond markets are obviously comprised of a lot of participants where half of them might not even believe in the rate cut theory at this point of time because it's a close call, like I said. I think the argument for a rate cut is predominantly from the fact that the growth needs a support and current account deficit is still not a problem, though BOP is a problem. So rates is not the way to, protect the currency. And like you said, you need to let the rupee depreciate. But having said all this, we really don't know what is the thinking in the minds of the RBI, with especially two critical members being new. I mean, the governor and, of course, the deputy governor who would be new when the policy comes out. So from that perspective, market is still grappling with whether there is a rate cut or not. So I would presume that we would go with a range of something like 665 to 680 kind of a range till February. Of course, a lot of things ahead of February, what happens to Trump policy announcements, what happens to our own budget prior to the policy, and what happens to the Fed minutes? Do they indicate something different? So a lot of things are there. So I would say 665 to 680. But if I have to go with the fact that we are on balance expecting a rate cut in February, I would say bond yields are headed towards 665 to 670 by end of March.
Okay. If there is a rate cut, 665. Is that your call?
That's right.
Okay. Well, Kaushik, the noise that we have heard from North Block is clearly pressuring the Reserve Bank. I mean, the November report, which was announced on December, the monthly review, clearly seemed to blame Reserve Bank for the slowdown. There may be a lot of debates on both sides of that statement. But given that pressure, you still think there can be a close call on the rate cut in February?
Latha, let me make 2 points over here. Analytically, if you see a framework in the last 20 years, the different monetary easing cycles, the pause period between the end of a rate cut cycle, a rate hike cycle, and the start of a rate cut cycle, the highest gestation period has been 11 months in 2 episodes. So compared to the 11 months or a year gestation gap, this time we have waited for almost 2 years before the start of a rate cut cycle. So I would assume some part of the liquidity tightening as well as the rate hike and the long gestation gap, macroprudential norms have started taking effect on growth, and this is what we expected for FY25. So we are not surprised with growth having slowed down, and you're going towards 6.5% level, which is below potential. So I think the second point related to this is that monetary policy has to be forward-looking. If you look at the monthly bulletin that RBI has taken out in December, and if you look at the forecast that they have given for growth and inflation, you'll see that in October, December, and January, March, they're forecasting growth to be 6%. If you look a little forward ahead, and if you look at inflation, from July, September, they're saying inflation would be below 4%, 3.7, and then below 4% throughout. So if you know that monetary transmission works with some lag, 2-3 quarters, then you have to start the rate cutting process now itself.
Yes.
So you can't delay that, and then you'll be further behind the curve. So I think that's why February and April, 25 basis points rate cuts make a lot of sense, and then letting it transmit to the real economy.
Okay. Very quickly, Prasanna, out of time on the first segment, though I have more questions. Why are you all going with only a 2% depreciation in the current year? It's a far more riotous year in terms of trade wars. Should we not have at least a depreciation that we had last year, 3%, which means at least 87.5 or 88?
Yeah, you're right, Latha. I think 2 to 3% depreciation on the INR is par for the course normally. But the way we have seen the Reserve Bank protecting the rupee in the past, makes us kind of be cautious in our estimate for the future as well, because we still, while we have seen a little bit of a change in the strategy of RBI in the way they protect INR in the last 15 days to 30 days, we still need to see what happens in a more volatile kind of a scenario. We still need to see what happens to yuan, because that's the joker in the pack. So yes, I would say 2% is a conservative estimate, but we are free to revise the stance as we go forward when we see more action from both China as well as from the governor.
Okay, well, I just want to leave the wrap up this segment with the understanding that, we must first of all stop giving a negative view to the rupee adjusting lower, because that is good for a large part of the domestic economy that's competing, as well as for our exports. On that note, a wrap up on the first segment. There's lots more lined up on Indianomics in terms of how our experts see the current account deficit, exports, and the global headwinds shaping up. Back after the break. Welcome back to this very special edition of Indianomics, the first in 2025, where we presented you a poll of how the macros and growth and inflation will pan out. And we have our experts, Upasna Bhardwaj of Kotak Mahindra Bank, Kaushik Das of Deutsche Bank, both economists, and the head of Global Treasury at ICICI Bank, B Prasanna. Gentlemen, and Upasna, thank you very much for waiting on. Upasna, if you can, map out the global headwinds, would you think that export growth and current account deficit could be problems in FY26?
Latha, I think, at this point in time, one of the biggest, I would say, tailwinds to begin with is crude oil prices.
Okay.
Despite the risk premium on geopolitics or any other such kind of issue, we haven't really seen too much of an upside coming to the oil prices. And if at all, there is downside going ahead. So I think that is one thing which is structurally holding up current account very well. That is, the other important aspect to keep in mind is the services trade surplus, that we are seeing, which is also expected to hold up quite well. On a monthly basis, we're seeing $17.5 billion of surplus, which is extremely good. That too is supportive of current account, overall current account balance. Of course, on the other side is the overall trade balance, wherein we know that there is some kind of an uncertainty to the gold imports. And that is something which we are looking for revisions, whatever happens. Once that is corrected, probably it is not going to be looking as, as alarming as the numbers that we've seen in the last 2 months.
Okay.
So this needs to be, the overall trade numbers needs to be seen with a pinch of salt. But of course, overall, I would say about 1.5% of GDP as current account deficit is not too much of a worry.
Okay.
With a slight amount of export slowdown already priced in as per our expectations.
Got it.
We're not that worried at this point on the current account. Of course, like Prasanna had said, we are more worried on the capital account side and hence balance of payment. I think that is where the bigger uncertainty would be. So when we're talking about global headwinds, then of course it boils down to the economic and the trade policies of Trump. And how the retaliation would be, with China and overall implications coming from there. So the capital outflow is where we assign a bigger risk.
I get that. And I take your point that the least worry perhaps for the policymakers is the current account deficit. We've seen 2.5% for decades. And therefore, a 1.2% of GDP current account deficit is really the least of the bother. I take your point entirely. I wouldn't worry about rupee and current account deficit, but I would worry about domestic liquidity. Prasanna, do you think that the liquidity hump is behind? Deposit rates, have they peaked at all? The Reserve Bank could be in a position of having to tighten liquidity because of external factors, sale of dollars, etc. So just map out, can we expect good credit growth this year? Can we expect lower cost of capital?
So I think, Latha, the ball is going to be completely in the hands of the Reserve Bank when it comes to giving enough liquidity in the banking system. And the reason I say that is also because of the fact that they have been intervening in the forex market. You all know that there is literally a $50 billion intervention that has happened that has actually sucked out liquidity. And on top of that, if you look at this year, they have also redeemed bonds which they were holding on the balance sheet, which has also led to reduction. Now, the CRR addition that the CRR reduction that they did led to an addition of liquidity of close to 1.25 trillion, but that is hardly, even offset the kind of deficiency in the liquidity that has happened over the last 1 or 2 months. So I think that more than the rate cut, the Reserve Bank has to be more proactive going forward in infusing liquidity into the banking system. Bear in mind that last time when we had a system liquidity deficit, the RBI was in a stance which was withdrawal of accommodation. Yeah. But this time around, they are in a neutral stance and they are possibly go into a easing stance in February, in which case they need to infuse liquidity and see the banking system liquidity to be at least neutral, if not positive. So from that perspective, I do think that, and also bear in mind that the last 3 months of this financial year, or the next 3 months rather, are typically seasonal times when your currency leakage is the highest. So from all perspectives, we are looking at a tight liquidity situation.
OMO,
but the saving grace is
OMO purchases.
Yeah. So I think there is a limitation up to which the RBI can do CRR cuts. I think what RBI is right now doing is being much more proactive in providing short-term VRR kind of liquidity to the banking system. But that does not do a lot to influence the behavior of the banking system, because all you're getting is 3-day money or 14-day money from the Reserve Bank. What you need to do is to do a little bit more core liquidity into the system. So I think open market purchases is something that we expect that RBI will be more active, have to do going forward, especially if FPI sell-off continues the way it has been continuing.
Yeah, they perhaps could not do it now, because between 6.5 and 6.7 10-year, if you start doing OMO purchases, you will have such a flat curve. But maybe after the rate cut, they will have a little more elbow room to do OMO purchases. Very quickly, out of time. But Kaushik, it does look, you have that 6.5% forecast for next year. Again, you are somewhat higher on the street. Wouldn't you worry that fiscal deficit is headed to coming down? So the kind of fiscal help is less, global headwinds are more, Reserve Bank's elbow room is lessened by the global pressures. Where is the optimism for growth coming for next year?
So as I mentioned, Latha, 6.5% growth is not good in India's own.
I agree. It's still better than the others.
It's better than the others, and we were used to 7% plus, and we are at 6.5%. But compared to the other countries, we look much better. So that is one reason to feel good about the India's growth trajectory. But the point is, in that 6.5% growth, I've already built in the 50 to 75 basis points rate cut for the current fiscal year that is coming. I think the question that you asked about liquidity, at some point, I think RBI will let liquidity become more flush in the next fiscal year, so that the short-term rates can actually fall to the SDF, and you'll have an effective easing of 75 basis points. I don't think RBI will want to cut repo rate more than 50 basis points, but they can easily have an effective easing by bringing in more liquidity. And OMO purchases are not just in terms of liquidity needs. You also need to bear in mind that next fiscal year, the supply, the gross borrowing would be much higher than what we had this year. And compared to that, on the demand side, you'll not have the bond index inclusion related money. So probably there would be a need for doing OMO purchases to ensure that yields do not move up too much, particularly when RBI is cutting interest rates. So from both liquidity standpoint, as well as the need for the demand supply balance of bonds remaining more or less, in balance, you would probably see OMO purchases coming through, but RBI will take the call when to do that, the timing, and how it can have the biggest bang for the buck. But I think February is a good time for RBI to start cutting rates, and then that will build into expectation of future rate cuts, and that itself can help growth. We are also seeing real estate sector to some extent slowing down. So a little bit of rate cut can give some boost. On fiscal, we are very clear that the government will continue with fiscal consolidation. We are looking at a fiscal deficit of 4.5 or slightly below that. So you'll not get that much fiscal impulse to growth. So monetary has to do the heavy lifting, in my view, to support a 6.5% growth next year.
Okay. Thank you, gentlemen, and Upasna, for giving us just whetting our appetite on the kind of growth optimism and pessimism that we will face in the coming year. A lot depends on the budget, but I'll take a rain check from all of you and invite you again before the budget to check whether, like the, the DOGE of the US, the government of India is also able to do some regulatory cutting off of, red tape, so that there are other kind of reforms that we can expect from the budget to push up the economy. Thank you very much for the maiden edition of Indianomics in 2025.